let's just talk about manipulation of financials, because whether it's legal or not gets to intent and, knowledge of the company, et cetera, et cetera. So let's just talk about significant manipulation of the financials, making the profits appear much higher than they really are, or less debt, et cetera.
I'm not calling it financial shenanigans. Would that be okay?
Yeah, and you could do that. I feel like that almost minimizes it in a way, because a shenanigan doesn't, what the kind of companies we look for, we're not saying, hey, your earnings per share really should have been 8% lower last year. It's more like 50% lower. So anyway, I guess this is semantics, but the first thing that I say is you really have to look for things that seem too good to be true. And, so companies that have operating, or that have margins that are significantly higher than their peers, even though they're in a business that doesn't seem like it's really that difficult to knock off, or companies that have been able to grow without interruption, despite looking at their peers and seeing that they have a much harder time of doing that. So companies that are outliers, now there are companies that are genuinely outliers, but you can understand why. Apple, okay, Apple is an outlier financially in the computer hardware industry in terms of its financial performance. But by and large, companies that do seem to be outliers in good ways, you really should take a pause and ask about that. Another is when you look at in the incentives, and one of the best quotes about life in general, but from Warren Buffett, who said, if you show me the incentives, I'll show you the outcome. Actually, maybe it was Charlie Munger. It was one of the two. And when you look at how management compensation is structured, so if you look at the proxy statements and you see that they're being awarded significant amounts of equity compensation for what we call non-GAAP metrics. So non-GAAP, you've got with your accounting, GAAP, GAAP stands for Generally Accepted Accounting Practices. And one of the real ills of our modern age in investing is this widespread acceptance, if not fixation, on non-GAAP measures of profit or profitability. And just a little bit of a digression, but early in my career in the late 90s, non-GAAP came into fashion when FASB, which is the Accounting Standards Promulgation Board, they decided that all of these internet companies that were awarding stock and options as compensation, that they needed to reflect the cost of those awards on their income statements. And the cost is in dilution. In the future, there will be more shares outstanding. And, like Wall Street hated this because, you're kind of peeing in the punch bowl here, FASB. And so they started talking about non-GAAP profitability. So if we X out the share awards, well, that concept was so popular and so successful, I say that with, hopefully you can detect a bit of sardonic tone in my voice, because we know what happened to the internet stocks after that point in time. They imploded, and this isn't the only reason why, but that concept, everybody likes that concept so much that so many companies now report non-GAAP numbers. That's what they highlight in their presentations. That's what the sell-side analysts write about and talk about. And those are so easy to manipulate. So again, going back to the incentives, when you look at how management's compensated, if they can get a lot of stock or options based on the attainment of non-GAAP measures of performance, that's a red flag too. So or at least a yellow flag. Companies that enter into a lot of acquisitions, a lot of transactions, that's often, that's something that you should look at. And there's a relatively long list and probably goes beyond the scope of your podcast. But the final thing I'll say on this, with the acknowledgement that few, even professional investors, have the time to do this, but in my firm's business model, we do have this luxury. I like to print out several years of transcripts from earnings calls and presentations and read them from earliest to most recent. And, you look for promotional language. If you do this over 3 or 4 years, there's always some new buzzwords that are really in vogue. Like right now, AI is picking up big time because of Chat GPT. So if you see CEO and the CFO that their language is constantly adapting to the zeitgeist of that moment, that tells you that these are very promotional people. And what I think a lot of investors don't understand is that, while you could sit there and say, well, gee, they're trying to get the stock price up, isn't that good for me? The reality is that you can step on the gas, a publicly traded company, almost any publicly traded company, you could step on the gas, juice results for a few years, juice the stock price, dump your stock, but leave the company a hollowed out husk of what it used to be or should be.